And as I've talked to more and more traders, I've had another epiphany, right? Hey, interaction, sometimes you learn things about what people don't know. I had this epiphany that retail traders don't understand the macro structures and institutions in place when they place a trade and how it protects them. I find that fascinating. I can't believe people are putting their money at risk, and this is why they get involved in Bitcoin at these levels, right? And say there is no risk. Those risks don't exist. That's when Dan gets torqued off. So what I'm saying here is they'll place a trade and they'll go long IBM, and they have no more concept of the macro structures and institutions in place that execute their trades and dilute sort of their counterparty risk. If I ask them, explain the structures in place that make sure that happens, I get blank stares. So what are we supposed to say at this point? I mean, we put it in that text entry earlier in the week. The market continues to grind higher. Markets are very quiet. I do still believe that when it breaks loose, it should be pretty epic. That 1.5 or 1.8% sell-off, that's not the market's breaking loose. That was static and that was noise. At this point, we've still got our long only and long flat processes just making brand new highs. As we said in the article, we said in articles weeks past, and as we're still saying, we still have one of our processes that is massively long the Qs. And notice how I phrase that. We have one of our processes that is massively long, and I do mean massively long the Qs at the moment. Grinding higher. We're just following that process. Markets are quiet, as we said in that article. Just be careful, all right? When it comes to trading, you have to show up to work every single day. You can't let complacency set in. And I'm saying that as much for my benefit as I am, trying to preach to others or anything. I'm not really trying to preach to others. That's not what I'm doing. I discovered this years ago. Trying to communicate and attempting to communicate, and it's difficult when people get complacent during time periods like this, but attempting to communicate with other traders, it keeps me sharp. Okay? Rob said this, and I told him, I'm going to steal that from you. I'll give you credit, but I'm going to steal it from you. I'm going to repeat it. But I thought it was beautiful the way he phrased it, is that communication is how we get smart, and it's how we stay smart. So in other words, when we're little kids, how do we learn? We learn by communicating, by interacting, right? And we become more intelligent through communication, through interacting with others. And the same is true when you enter a secular field. Like if you want to be an investor and trader, if you want to improve, you have to interact. It can't just be Dan being this, the talking head, blah 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 blah. It can't just be Dan being some talking head that people tune into, right? There's got to be trader interaction. If they're not, they'll get complacent, they'll fall asleep at the wheel, and that's how accidents happen. It's how accidents happen in the markets. Other than that, what are we going to say? We've still got our long only and long flat processes continuing to grind higher. I've been trying to find some short entrances, and I'm not even seeing the trigger. So I could just go blind short, and that would be an actual strategy. There's actually a procedural way to do that. Just go blind short. It's just not my style. Probably 2% of any trading process is the entrance. For some reason, all new traders focus in on entrances, and it's like that's like 2% of the equation, literally. But even looking at just that small percentage, and I don't like to hyper focus on entrances, but I do look for entrances as a very small portion of our process, and I'm just not finding any short entrances. I'm just not. So we continue to grind higher on our long only processes and our long flat and long Yeah, it's just like, yeehaw, made another new high, right? I put in one article, well, we made a new high earlier in the week and it's dipped about 6 basis points. Oh, no. By the time I went back and looked at all of the reports, nope, we'd made another new high. That's when complacency sets in. That's when complacency sets in. It's allowed me a little bit of time to do some research. What we did is I had an idea for a new trading process, and so I back tested it straight through, and I did it by hand. That's the best way to do it. Back tested it back partially to 2003. It's all in sample data, and then I took it back to 2007, and I spent about 3 days on it, and I came to find out that basically the whole thing's a bust. Literally, it was a great idea. It sounded wonderful. It's like, man, that would really work out great. So I took a bunch of in-sample data and I put it down on paper. And you know what I found? One of the processes we already use, it increased the volatility and there was no improvement in the performance. So it's like, well, that's not what you want to see. And I think it's because I took the strongest alpha component of it and I tried to get fancy and hedge it off in certain circumstances, and all I ended up doing was, it's like the returns came back down to baseline and it increased the volatility. So I was like, well, that's definitely not what you want to see. So I'm considering that whole 3-day, 2-day or 3-day experiment, whatever, as a complete failure. But even doing that, even grinding that out for myself, that helps, right? You learn, and I think I know what I did wrong, and I think I know where that combination is wrong, and I try to get fancy with, like I said, with the hedging component. Now I know, right? But the quiet times provide you with an opportunity. That's what I'm trying to say. And one thing I've been doing is, as I often do, and many of us do, is I've gone out and perused the old landscape of the interwebs. Of the interwebs in finance, and the interwebs and the internets when it comes to trading. Wow, folks are crazy. They're just nuts. I'm going to say this, right? So the big hoopla has been on Bitcoin. Bitcoin making new highs. Bitcoin making new highs. I told the group of traders that I talk with, I told them this. I'm not trading Bitcoin. I don't want anywhere near it. God, don't you know, Dan? Don't you know it's going to go higher? I don't care. I'm going to introduce you to 2 words here in just a second. Okay? And you need to learn them. If you want to have longevity, if you want to have longevity in the career of investing and trading, you have to learn these 2 words, okay? But I don't care. Okay, I don't care. I don't care whether Bitcoin goes up or down. I'm not saying it's going to go down. That's not why I'm not getting involved in Bitcoin. And I don't think people understand this. And it really torques me off. Because I've been trying to say the same thing for 10 years and people go, those are big words. It just, God, just don't be lazy. I hate laziness. And I despise intellectual laziness when the person has the mechanisms at hand to broaden their horizons. I hate that sort of laziness worst of all. So anyways, it's not about the fact that I think Bitcoin's going to go down. It has nothing to do with directional risk. Well, why not use a stop-loss order? You're going to talk risk management. Isn't that what a stop-loss order is for? No! Whether someone gets involved in Bitcoin or not, I don't care. I don't care. Whether somebody wants to go long Bitcoin right now, I don't care. Go, just do it. I'm going to say the same thing I've said for the last God-blessed 10 years. Understand the risk of what you're doing. I understand the risk because I got a stop-loss order. Screw your stop-loss order, okay? I don't care. And again, this is what I told several other traders. I don't care if you go long Bitcoin. I don't care if you short Bitcoin. I don't care if you want to get involved in Bitcoin. I don't care if you want to mine Bitcoin. I don't care. What is the risk, right? And as long as somebody looks at Bitcoin and says, I understand that risk, and I'm willing to take a measured risk, understanding that those risks are in place, bang on to you. Go for it. If you could put Bitcoin on a regulated exchange where all of the safety protocols are in place, and that's what I want to talk about here, where I know my counterparty risk is diluted enough to where I'm going to be safe, I would literally be knocking skulls together trading Bitcoin. If you could make sure that Bitcoin was liquid, deep, and thick on a market where I could see that with my own two eyes, and I know, and this is absolutely critical, where I know for a fact that my counterparty risk is pretty well heavily diluted, I'd be knocking people's skulls together. I'd be crushing skulls underneath my boots as I trade Bitcoin. And I say that and people go, it's not on a centralized exchange, and that's why you should be trading it. Those risks are... No, you didn't listen to a God-blessed word I said. And as I've talked to more and more traders, I've had another epiphany, right? Hey, interaction, sometimes you learn things about what people don't know. I had this epiphany that retail traders don't understand the macro structures and institutions in place when they place a trade and how it protects them. I find that fascinating. I can't believe people are putting their money at risk, and this is why they get involved in Bitcoin at these levels, right? And say there is no risk. Those risks don't exist. That's when Dan gets torqued off. So what I'm saying here is they'll place a trade and they'll go long IBM, and they have no more concept of the macro structures and institutions in place that execute their trades and dilute sort of their counterparty risk. If I ask them, explain the structures in place that make sure that happens, I get blank stares. Well, it's not on a centralized exchange, so that's why Bitcoin's great. No, shut up. That's not what I said. So it flabbergasts me, right? I've often commented on the fact that I've investigated a little bit on microstructure execution, something completely and totally different. That's not my specialty. I could speak a little bit about it in generalized knowledge, but that's all I can. And I find it humorous that so many people proclaim themselves as experts in the microstructure execution space, and they just literally, as soon as they open their mouth, they sound like a complete and utter idiot. But on the opposite side of the coin, going to macro structure, just the execution, the institutions at place as to how trades are executed, the different, I guess it gets into microstructure a little bit, but not microstructure, just how your trade gets routed. Just how your trade gets routed. And the institutions at place to dilute your counterparty risk. And what I've learned is that people have no concept of what counterparty risk even is. They like literally, you say those words and they go, what? Here's the two words you need to learn. What is your risk profile? I was trying desperately to have an interchange with this brand new trader, right, about what does your risk profile look like when you're doing that. That's what I'm talking about. And I got a bunch of nonsensical, stupid replies, and I said, listen, just do a little bit of research into risk profiles, and I'm not talking about directional risk. I'm talking about your entire risk profile. Well, that doesn't make any sense. And he came back with me about stop-loss order or something completely and utterly ignorant. And I just thought, you're just like rock, maple, dense. You are just dense in the head. Here, let me Google that for you. What is a risk profile? What is your risk beyond just the simple, well, it could go up or it could go down? There's other risk. We say that in our money management playlist and series. And we don't tell you what all the risks are. We say, go out and learn about them. Interact with other traders as you're learning about other forms of risk. And one of those forms of risk on the risk profile is your counterparty risk. And how is that diluted? Here, because everybody is freaking lazy, intellectually lazy, even though literally they've got the compendium of all human knowledge sitting right in front of them. Let me illustrate this for you. You sit down to play a poker game, right? So you get to sit down to play a game of poker, and you got two guys at the table. How do you know the guy sitting across from you, as you're throwing in those ceramic clay chips into the middle, how do you know that the guy on the other side of the table has got the cash to cover those chips? You have now been introduced to counterparty risk. You're welcome. So my God, that's where I get ticked when it comes to Bitcoin. That's where I get ticked. Is not whether somebody gets involved in Bitcoin, whether they mine Bitcoin, whether they don't mine Bitcoin, whether they say, no, I think that's too risky. That's not what I'm talking about. What I'm saying is when there's no dilution of just that counterparty risk and it just gets diluted, just the way basically institutions are set up now when I institute my trade, don't tell me that that risk doesn't exist. Now, if you look at me and say, yes, I understand that that risk exists, but I'm still going to take a measure risk here, you know what I say? Bang on to you. Bang on to you, more power to you, and you should definitely be, get involved if you want to get involved. Absolutely. But don't look at me and say that that risk doesn't exist. And what blows me away is I was, again, having this conversation on Bitcoin about that's not a risk that I want to assume, right? And the person was trying to tell me, well, that risk doesn't exist. See, now I'm getting torqued off. And I thought, wow, how incredibly short people's memories are. Just how incredibly short. Was that 3 years ago? What do you think? This is 2017. Was that 3 years ago or 2 years ago where people just got introduced real quick to counterparty risk, specifically in Bitcoin? Specifically in Bitcoin. People's memories are so short. So incredibly, it's as if they have amnesia. That it's like if it was 2 years ago, they've just forgotten it. Hey, you know what? People could get involved in Bitcoin and make $13 million and do so a lot faster than Dan's going to make his next $13 million. Absolutely is that true. But are you willing to accept the risk profile for doing that? And that risk profile is just way too steep for Dan. That's what I'm saying. At the same time, I can't get too upset because so much of that naivety exists in the marketplace is, let's be brutal here, it's the way I make money. So, if you tell people though that risk exists and you need to face it and they don't want to, then I don't want to hear any crying and moaning and whining when that risk blows up in their face. But that's just been our thoughts. Hey, if you've enjoyed this video, go ahead and feel free to punch that like button. That helps us out. We appreciate it. At the same time, if you have not subscribed, go ahead and hit that subscribe button. And there's, I think, a notification bell that they use now that you may want to check out. We have plenty of free stuff for folks that we put on sort of the front side, the public side of the house of what we do. We have, let me think here, we have education series. We have 3 educational series. How to begin with investing and trading. That's for folks who are obviously brand new. We have a playlist called Money Management for Investing and Trading. That's sort of like optimal math over an iteration, the mathematics of short-term trading. And at the same time, we have a playlist or free course, free series on trading psychology and emotional discipline when it comes to trading. We also have a free Sharpe income project, something done live in real time with actual moves made. We talk about it each week on the public website, sharpetrade.com. And we also have the premium products, valuation investing course. I've also thought about inserting another video because those courses we're going to continually tweak over time, and we haven't done that in a while. I'm thinking on the valuation course, I'm thinking about inserting something in there about a whole nother model that would actually probably basis-wise, just in terms of basis points, perform better than the model we have there in the evaluation course. But it's just, again, what sort of risk profile and volatility do you want? And those are decisions we all have to make for ourselves, as I was saying earlier about Bitcoin. So I've thought about doing that in the valuation course, but that has stuff on like evaluating individual stocks and the basics of evaluating individual stocks and models for longer term investing and how you would think about putting something together, and as well an actual model, an actual process that produces really great risk-adjusted performance metrics. We have our short-term trading course, and we have the Sharpe report. Okay? And that's what we got, and that's what we do. And that's just been what it always has been. That's simply been our thoughts, not yours, for whatever the heck date is. As always, stay safe, trade well, and remember that love doesn't cost a dime.